Hello viewers, welcome back to the channel. Today we are going to study the second unit under the subject Principle of Insurance and Loss Assessment. We have seen some introduction of this subject. Today we will continue our previous session. This is the name of unit 2, fundamentals or principles of general insurance. So today we will talk about some general principles which apply when we take any insurance. uh, Today's topic of discussion, so contract of insurance first we will see, then conditions necessary for contract. After that we will see principle of general insurance, and what is material fact. And then we will see some general principles, that is utmost good faith and insurable interest. We will see a concept when time involved in the insurance, how this works, and then what does assignment means in the insurance. So today we will finish this unit 2. If the video goes very long, I will create two separate part uh, to make you very convenient while watching the lectures. So first let me see contract of insurance, what it is. When the insured pays the premium and insurer accept the risk, the contract of insurance is concluded. Okay, so one party is insurer and the other is insured. So when both parties accept the risk, one accepted to pay the premium and other takes the risk, so can contract is created. The policy issued by the insurer is the evidence of contract. So when you will take any insurance, you will get a copy of policy. So this will be the proof. Okay, so this is the contract of insurance. Then we will see some conditions which is necessary for a contract. So what are these conditions? First is there should be consideration. Okay, there should be consideration, that is there should be offer and acceptance. Okay, so one party will offer something and other will accept it. Okay, both parties and one party will give the offer and other party will accept. Okay, so this is the first condition, and nothing will be free. There should be a consideration for any contract. There second is there should be consent of both parties. Okay, one party is insurer and other is insured, so there should be a consent between the both parties, and the both parties should have sound mind, or I should say same mind, with common intention. For example, if proposer desire a fire insurer and the insurer issues a third policy, there is no consent arising out of common interest. Okay, so the insurer should give what insured has asked. Like if I want a fire policy, I should get a fire policy. Okay, if I want a theft policy, then I should get a theft policy. Okay, the third point is the parties to contract must be competent. Okay, minors and person with unsound mind are not competent to sign a contract. Okay, so he should be a healthy person, I should say. The object of contract must be legal and not against public policy. For example, stolen goods cannot be insured. Okay, so you cannot say that if something is legal, I want insurance for that. Okay, so you cannot insure something which is illegal. Okay, principles of general insurance. So now we will see some principles which is involved in the insurance. Insurance contracts are subject to certain special principles involved under common law in the UK and are generally followed in Indian court. Okay, so as we all know, our constitution are taken from different countries. So this is taken from US. The principles are UK. The principles are known as fundamental or basic principle of law of insurance. Okay, so first principle is utmost good faith. Okay, so we will talk about it in depth so you can understand it better. So let's see. The parties to a commercial contract according to law are required to observe good faith. Okay, there should be good faith. The seller cannot mislead the buyer in respect of transaction, but he has no obligation to disclose all the information about the subject of the contract. Okay, this is important, that the seller, okay, which is selling the insurance, has no obligation to disclose all the information about the subject of the contract. It is the buyer's duty. Okay, it is the duty of buyer to be careful when entering into the contract. Okay, so it's buyer duty. So let the buyer beware is the legal rule. In insurance contract, there is duty of utmost good faith and giving material fact information. We will see what is material facts in subsequent slides. The proposer has duty to disclose all material information facts about the subject matter of insurance to the insurer. The material fact is that enables insurer to decide whether to accept the risk and the rate of premium. So what is material fact? These facts help the insured to know that is is the conditions is okay and I should pay the premium or not. Okay, and the terms and insurer, the rate of premium and terms and condition of the acceptance. The duty applied not only to the material facts which the proposer know, but also extend to the material fact which ought to know. Okay, so some general knowledge that insurer should give to the insured should be there. Okay, what is material fact? That was I was taking. So the material fact in case of fire example I have listed here, like construction of the building, how the construction has been done. In the case of fire insurance, we have to disclose it. Okay, what type of occupant lives there? Is it a residential building? Is it a office building or a shop or a go down or a manufacturing unit? Because the risk increase or decrease with respect of occupation and types of contractor construction. And the third point is the nature of goods. Okay, how which type of goods you are storing in the building, or which type of manufacturing you do. Is it hazardous or non-hazardous? You should tell to the insurer. Okay, okay, so that is in the case of fire insurance. And what will be the material fact in case of motor insurance? So it will be a cubic capacity of the engine, how much the engine takes in terms of cc, the year of manufacture. Okay, carrying capacity of truck, if it is a truck then you should disclose it, the purpose for which the vehicle is used, and the geographical area in which it is used. Okay, so you have to disclose the locality also. Please note, if the insurance is placed through a agent, the agent has similar duties to disclose all the material fact known to him or communicated by the proposer. Okay, so it was about material fact. Let us see some more points about utmost good faith. I have prepared the last slide so you can understand the material fact in depth. So now we will see utmost good faith principle in detail. Facts which are common knowledge or matters of law need not to be disclosed by the proposer. Okay, so the law which is involved is not to be disclosed. For example, if a proposer seeks a riot cover, he need not disclose the fact of prevalence of riot conditions. Insurance are expected to know about it is the normal course. Okay, the duty of disclosing material facts is when the contract is concluded by the by the issue of a cover note or a policy. Okay, you will give details about the material facts in a cover note or a policy. The duty arises again at the time of renewal of the policy. However, a policy condition provides that duty also arises during the period of policy if there is any change in the risk. Okay, so you have to tell to the insurer that this change I have made in my building, or in machinery, if you modify anything, so you have to tell to your insurer that these changes have been made. And some policies have a annual clause to review the conditions, okay, at the time of renewal. So the breach of duty of utmost good faith may arise unintentionally through an oversight or because the proposer thought that it was not a material fact. So this may happen that you don't know it is a material fact, and the duty got breached. So if there is non-disclosure or misrepresentation with fraudulent intention, the insurance contract will become void. If anything happens like that, the contract of insurance becomes void. It will not be contract at all. Okay, if duty of utmost good faith is breached in any other way, okay, it is one way, and if it is it is breached by any other way, the contract becomes voidable. Okay, these two are separate terms. When we will learn the contract, I will teach you what is void and what is voidable, and different terms which is related to the contract. For now, we are focusing on insurance, so please keep in mind these two terms, that these two are different. Like void is different and voidable is different, which will mean the insurers have the option to avoid the contract. Okay, so if duty got breached by any other way, the insurer have an option to avoid contract and reject the claim. Okay, so the option is for insurers. Unenforceable contracts are those which cannot be produced as an evidence in the court of law. Okay, so if you got insurance for anything which cannot be enforced in the law, so it is not valid. If an insurance policy is not stamped as per the Indian Stamp Act, the contract become unenforceable. Okay, so when you are executing the contract, if it is not stamped as per Indian Stamp Act, it is also not a valid contract. Okay, so now let's see what is the another principle which is involved while doing a insurance. This is insurable interest. Okay, this is a very important concept in the insurance. The owner of the property has a right under law to effect insurance on the property. Okay, this is the right of the owner. If he is likely to suffer financially when property is lost or damaged. Okay, these are the cases when I can take insurance if I am an owner and it is my right. This legal right to insure is called insurable right. This right is called insurable right. Okay, without insurable interest, the contract of insurance will be void. Because of this legal requirement of insurable interest, insurance contracts are not gambling transactions. Okay, if you do not have the legal right, or you are not a owner, you cannot insure anything. uh, this prevent gambling. Example of insurable interest I have listed below. First is ownership of property. This is a clear example of insurable interest. A bank has insurable interest in the property on the mortgage of which loans have been given. Okay, so banks also have the insurable interest. The interest is limited to the amount of loan. Okay, so it is not like owner, but the interest is limited to the amount of the loan. Usually under such circumstances, the policies are issued in the joint names of the insured and the bank. Okay, so in this condition, what will happen? They will name you and the bank simultaneously to get the right of insurance. So what will happen in the third point? A ship owner has insurable interest in the ship owned by him. Okay, cargo owners, both sellers and buyers, have insurable interest in goods owned by the owner. Okay, so if you are transiting any good, so you also have the insurable interest. The owner of the motor vehicle has insurable interest in the vehicle. Okay, he also has insurable interest in potential third party liability. You all know third party insurance. This is the case. If the third party is injured in the accident, the damage payable to the third party will also be financial loss to the insured. Okay, if something happened to the third party, you have to bear the financial loss. That's why you have the insurable interest. Hence, he can insure his third party liability also. Okay, and then one more example: a person has insurable interest on his own life too. Okay, so another concept, that is time when insurable interest should be present. So let's see what it means. In fire and miscellaneous insurance, insurable interest must be present both at the time of taking the policy and at the time of loss. For example, if the property insured under fire insurance policy is sold and there is a loss after the sale, the insured cannot recover the loss as he has no insurable interest at the time of loss. Okay. In marine cargo insurance, insurable interest is required at the time of loss. Okay, when the goods will lost at that time, we need insurance. It may not be present at the time of effecting insurance. An importer of goods may insure the goods under a marine policy, although at the time he may not be the owner of the goods. Okay, I am just transporting the goods, but I have the interest. Ownership of the goods passes from the exporter to the importer when the payment is made. If goods arrive damaged at the destination and if the importer had paid for the goods, he can recover the loss as he has insurable interest at the time of loss and also has a policy. Okay, so in the case of marine policy, we need insurance at the time of loss. Okay, in marine hull insurance, insurable interest must be present both at the time of taking the policy and at the time of loss. Okay, so this is the concept of time in the insurance. Now, one more term which we should know about insurance, that is assignment. What assignment means? So, assignment in normal language we can see transfer of insurance rights from one person to another. Okay, what assignment means? Transfer of insurance rights from one person to another. The insured person changes and the benefit of the policy move to the someone else. In simple words, let's see example. You insured a property. Okay, later you sell that property to another person. Now the new owner wants the insurance benefit. This transfer of insurance rights is called assignment. I hope you got the point. One important thing, assignment is possible only when the new person has insurable interest. Just one slide back, we have learned the insurable interest. This is the case. Okay, assignment, when insurable interest should be present. Assignment means transfer of rights and liability of insured to another person who has acquired insurable interest in the property insured. Okay, this is the property. Then generally fire and miscellaneous insurance policy are assigned only with the consent of the insurers. Okay, in this policy, consent is there. Okay, insurer's consent is there, because when you will transfer the ownership, the risk may vary due to the usage, how the next owner will treat the property. So you have to tell the insurers and get the consent from the insurers before giving the transfer of insurance. So assignment does not work like that. In marine cargo policies, however, freely assignable without the previous knowledge or consent of the insurer. Okay, so in marine cargo, it is allowed, because the ownership of the goods insured under a marine cargo policy frequently changes when the goods are still in transit. Okay, so they move from one ship to another or one place to another, and it is necessary that the benefit of the policy should pass to the new owner. Okay, a marine hull policy cannot be assigned without the consent of the insurer, and this marine hull is different. Okay, marine cargo is different. Indemnity. So this is our next important principle, indemnity. The principle of indemnity arises under common law and requires that an insurance contract should be governed by the principle of indemnity. The objective of principles is to place the insured in the same financial position as far as possible as he could immediately before the loss, as he occupied immediately before the loss. The effect of this principle is to prevent the insured from making any profit out of his loss or gaining any benefit or advantage. Okay, so how it is, let's see some examples. The measure of indemnity applies to some type of property is explained below. First type of property is building. In these cases, the cost of reinstating the building or repairing the damaged portion is assessed, and from that the appropriate allowance is made towards depreciation depending upon the age and condition of the building. Okay, so what it is saying that if you take insurance and you claim it, the principle says you should not get above the value of that asset. Okay, if you have any building and its cost is like 1 lakh, and you claim for 1.5 lakhs, so it should not happen. So how we prevent that? We apply some principles. So what we do, we do not replace materials as new. We apply some depreciation on the materials. Okay, and we apply some more things like what is the age of the building, what is the condition of the building. So by applying these principles, we deduct some amount from the value of the property if it is new. So you get some deducted amount. Okay, in case of masonry, let me see, you will understand it better. In practice, the measure of indemnity is the replacement value. Okay, replacement value at the place and date of loss or damage, less, okay, we will subtract something, less an appropriate allowance towards depreciation. So we will deduct depreciation from the replacement value, not from the new as new. We are deducting from replacement value. If the damaged machinery is repairable, the measure of indemnity is the cost of repairing the damage. Okay, if it is repairable, we will bear the cost of repairing as an insurer. If, however, during repairs any part is replaced, an appropriate allowance is to made towards depreciation of the total cost of repair, including labor cost. Okay, that is how we apply the principle of indemnity. In case of stocks also, in respect of stocks of wholesalers and retailers, the measure of indemnity is not the selling price of the wholesaler or the retailer, but it is the price at which he can replace the goods. The element of expected profit does not play any part in computing the measure of indemnity. Okay, so it is in the case of stocks. In case of motor insurance, the indemnity shall not exceed, first is the total or constructive total loss of the vehicle, the insured's declared value of the vehicle, including accessories thereon, as per schedule of the policy, less the value of that wreck. Okay, so we will deduct from the declared value. Another is for partial losses, costs of repair or replacement as per depreciation limits specified in the policy. Claims for third party liability are indemnified as per law, subject to limits, if any, under the policy. Okay, so these are the various cases, and how we apply indemnity we have seen. Like in marine insurance we can also see, and in personal accident insurance we can also see. If you want to read it, it is up to you. I am skipping it. You can pause the video and read it out. These are the example of indemnity I have just written here, so that you can understand it is in detail. Now we are looking at limitation of liability of insurer. Okay, if I am selling any insurance, so what are the limitation of liability? So the sum insured is the maximum limit of liability under the policy and is always defined in the policy. Okay, so I will define a sum insured while giving policy, and I am not obliged to do, or I am not I will not asked to pay more than that. Okay, if sum insured is less than required, the condition of average will be applicable. In such case, only the proportion of losses payable which the sum insured bears to the market value of the insured property at the time of loss. Okay, the third limitation of liability of insurance is some policy are subject to access or franchise. Fourth is the difference between access and franchise should be clearly understood in either case if the loss does not reach the limit. If is not payable at all, it is if it exceeds the limit, if it is going beyond the limits, the excess only is payable under the excess clause, and the entire loss is payable under the franchise clause. For example, we will understand it by an example. Don't worry, I know it is a bit tough. If there are two insurance policy, A and B policy, okay, one policy is A, another is B. A subject to an excess of rupees 1000 and policy B subject to a franchise of rupees 1000. And if a loss of 500 is reported under each policy, nothing will be payable under both the policies. Okay, because loss is rupees 500. Okay, if however the loss under each policy was rupees 1100, policy A will pay A will pay policy A will pay rupees 100 only, but policy B will pay rupees 1100. Okay. Now, salvage is property which is partially damaged by the fire, for example, and if the full loss is paid, the insurers may take over the salvage and dispose it off. Okay, if someone is paying you salvage, like if in the case of fire everything got burnt and salvage remained, and your insurer paying you the salvage, then he can take the salvage with him. Okay, and he can dispose of, or he can sell it to anyone else or resell it. So it is not your concern. He is paying you, okay, for the service also. So this is also the liability of the insurer. I hope this is clear to you. Subrogation under policy condition. What subrogation means, let's see. The right of subrogation is implied in all contracts. Okay, it is there, of indemnity, and is automatic and without any express condition in the contract. It is not expressly written, it is implied in all the contract of indemnity. You must remember. Subrogation may be defined as the transfer of rights and remedies of the insured to the insurer who has indemnified the insured in respect of the loss. If the insured has any right of action to recover the loss from the third party who is primarily responsible for the loss, the insurer, having paid the loss, is entitled to avail himself of these rights to recover the loss from the third party. Okay, so we will give an example of subrogation in next slide. Just be with me. The effect is that the insured does not receive more than the actual amount of his loss, and any recovery affected from the third party goes to the benefit to the insured to reduce the amount of his loss. Okay, so if insurer is paying you the damage, you are not entitled to get the damages from the third party. Okay, so according to this principle, the insurer will be entitled to get the amount or the compensation from the third party. You are not able to get that. The principle may be illustrated by the following example. Let's see what subrogation means. If cargo is damaged due to the negligence of a carrier, okay, carrier means railways, truck operators, or shipping companies, who has an obligation to make good the loss of the insured, the benefit of this obligation passes to the insurers. Okay, so if you got the compensation against the damage, so the insurer will be entitled to get the compensation from the third parties. The right of subrogation is implied in all contracts of indemnity. In other words, its application to contracts of indemnity is automatic without any express condition in the contract. It arises, however, only after payment of loss. Okay, first they will pay you, and then they can recover from the third party. Fire and miscellaneous policies contain an express condition to the effect that the right of subrogation can be exercised by the insurer even before payment of law. Okay, if it is written, they can get the payment before the claim. In certain circumstances, if it becomes necessary to take action immediately against a third party in order to ensure that the right of recovery are not prejudiced by any delay. Okay, if it is the case, so the right is there. Marine insurance policy are subject to the doctrine of subrogation, but the policies do not cover any conditions and the insurers are subrogated to the right of insured only after payment of claim. Okay, in marine condition, so this is the case. And the IRDA regulations make specific provisions that the policy holders shall assist the insurer in a recovery of claim from other parties. So it is also a policy holders responsibility. IRDA has make the provisions. We are just heading towards the end of our session. Just be with me. One more term is their contribution under policy condition. So what it says, let's see, it is very simple. If an insured takes out more than one policy, say two policies are there, he cannot recover the claim two times. It would amount to making profit. He can recover only one claim from any one of the insurance company, or each company is liable to a rateable proportion of the claim. Okay, so how it is? Here is one example I have made. Sum insured is rupees 3 lakh. Uh, so claim is 1,80,000. Sum insured with insurer A is 50,000. A pays 30,000. Okay, so A, B, C is the three insurer. So I have taken three policies here. So A pays 50,000, A pays 30,000. Okay, and B pays 60,000 and C pays 90,000. He has the policies with them. So total is what? Total is 1,80,000. Okay, so the application of the principle of contribution is subject to the following prerequisites. Okay, here in this example, what I was trying to say, that he got 1,80,000. Claim was 1,80,000. He cannot do that, like he cannot take 50,000 from A and 1 lakh from here and 1,50,000 from here, because it will give more money than the claim. So under the contribution, he cannot get more than his claim. Okay, he cannot make benefit out of it. Okay, so the application of principle of contribution is subject to the following prerequisite. The subject matter must be common to all policy. Okay, so there should be a common claim. The pearl which is causing loss must be common. Okay, so if he is claiming for fire policy or a fire incident, so he should claim for fire in all three cases. The interest covered must be the same in all policies, must be in favor of same insured. Okay, the policies must be in force at the time of loss. The policy must be legally enforceable. So these are the conditions for the contribution. Proximate cause, this is the last term that we should know. After that, this unit is over. What it says, in an insurance contract, the claim or loss of the property is payable if it is caused by the pearl insured in the policy. Similarly, if it is caused by uninsured pearl, it is not payable. So okay, the pearl should be insured. Pearl is risk, I have told you in my first lecture. If the loss is caused by burnt pearl, only it is easy to decide if the claim is payable or not. Okay, if there is one pearl, we can decide easily. In actual situation, the loss may be the result of two or more causes acting simultaneously or one after the other. That may be the case that two different causes may be there. So what will happen? It becomes then necessary to choose the most important, the most effective, and the most powerful cause, which is what about the loss. This cause is termed as proximate cause. All other causes being considered is as remote. So okay, so and the cause which is primary is called proximate cause, and all secondary causes are called remote causes. So this is the example I have mentioned. One example here: a person insured under a personal accident insurance policy went out hunting and met with an accident. Due to the shock and weaknesses, he was not able to walk. While laying on the wet ground, he contracted cold. Okay, so he got cold also, which developed into pneumonia, which caused his death. The court held that the proximate cause was accident covered in the policy and the remote cause was pneumonia, hence claim was payable. Okay, this may be the case and proximate cause will apply here. One more example I have written here. You can read it for your understanding. I'm not reading it. This is all from my side, and this was unit 2, and it is finished here. In the next lecture, we will see fire and pulse policies. So be with me. Thank you for your support, and I am also posting MCQs on YouTube under quizzes, which you will get in community section. Please visit community section and attempt those MCQs. I am uploading daily 5-6 MCQs there. I will prepare shorts also, but it will take some time. So just practice these MCQs. This will be very helpful, and I will also make topic wise MCQs here. So till then, bye bye. Thank you.